What's going on, everybody? Welcome back to Ledger Pulse. Today we're breaking down a major liquidation event that hit the crypto market, but more importantly, what's happening underneath all that volatility. Because while traders were getting wiped out by rapid price swings, something very different was unfolding across Washington, Wall Street, and the global financial institutions. Regulation is moving forward. Tokenization is accelerating, and blockchain infrastructure is quietly being integrated into traditional finance systems at a faster pace than most people realize. So in this episode, we're covering the $600 million liquidation event, U.S. crypto regulatory momentum and the Clarity Act push, institutional tokenization expanding through major financial firms, DTCC and Chainlink infrastructure development, Bermuda and Stellar's move toward onchain finance, Asia's continued integration of crypto into banking systems, and XRP's increasingly central role inside institutional financial frameworks. As always, none of this is financial advice. This content is for informational and entertainment purposes only. Always do your own research before making any investment decisions. So first, the market move that set everything off. More than 600 million in leveraged crypto positions were liquidated during a sharp downside move across the market. And this is a familiar pattern in crypto. When momentum is strong, leverage builds. When price reverses, that leverage unwinds quickly. And when it unwinds, it accelerates the move even further. That's what makes these events so violent. It's not just selling, it's forced selling. But here's what's interesting about this moment specifically. This kind of volatility is happening at the exact same time the foundational structure of crypto finance is being built in the background. So while the surface looks unstable, the underlying system is actually expanding. That disconnect is becoming more visible with every cycle. Now shifting to Washington, Senator Cynthia Lummis has publicly pushed for advancing the Clarity Act as part of a broader effort to define clear crypto market structure in the United States. And whether you agree with the specifics or not, the direction is what matters. The U.S. is actively moving toward formal regulatory frameworks for digital assets. For years, the biggest issue for institutions wasn't adoption, it was uncertainty. What is a security? What is a commodity? Who regulates what? How do institutions legally participate? That uncertainty created hesitation across traditional finance. Now, lawmakers are actively working to resolve those questions. At the same time, regulatory voices and industry groups continue to emphasize that clarity isn't just about control, it's about competitiveness. Because whichever jurisdiction defines the rules for tokenized finance also defines where capital flows next. This is no longer just crypto regulation, it's financial system design. While markets were selling off, institutional tokenization developments continued to accelerate. Payward, Kraken's parent company, and Franklin Templeton are actively expanding initiatives focused on tokenized investment access and on-chain financial products. That matters because Franklin Templeton represents legacy asset management entering blockchain infrastructure directly. This is not experimental branding. This is product development. At the same time, Fidelity International has launched a Moody's-rated tokenized liquidity fund utilizing Chainlink and Signum infrastructure. That combination is important. Traditional asset management, Fidelity, credit rating frameworks, Moody's standards, and blockchain infrastructure, Chainlink and Signum. This is the structure of regulated finance beginning to transition on-chain. And the implications are significant. We're moving toward a system where funds, liquidity pools, treasury instruments, and real-world assets can exist in tokenized form with programmable settlement layers underneath them. That turns blockchain from a speculative asset class into financial infrastructure. One of the most important institutional developments involves DTCC, exploring blockchain-based collateral mobility initiatives in collaboration with Chainlink infrastructure. And to understand why this matters, you have to understand what DTCC represents. This is one of the core post-trade clearing and settlement institutions in global finance. So when systems like this begin experimenting with blockchain rails, it signals something very specific. The modernization of settlement infrastructure is already underway, not in theory, in practice. This doesn't mean any single blockchain takes over finance. What it does mean is that financial systems are actively exploring automated settlement, tokenized collateral movement, real-time reconciliation, and interoperable financial data layers. And as this shift continues, Projects focused on liquidity movement and settlement efficiency naturally re-enter institutional conversations. We're also seeing early-stage jurisdiction-level experimentation. Bermuda is actively moving forward with initiatives aimed at bringing parts of payment and financial services infrastructure on-chain through the Stellar network. This is part of a broader global trend. Governments and financial regulators are no longer just observing blockchain systems, they're testing them, and in some cases, integrating them into controlled financial environments. Across multiple regions, we're seeing parallel development in digital payment systems, tokenized asset frameworks, stablecoin infrastructure, and regulated blockchain settlement experiments. This is becoming a competitive landscape. Countries are positioning themselves for what comes after traditional financial rails. In Asia, integration continues to move steadily forward. In Japan, SBI Securities and Rakuten Securities are preparing crypto investment trust offerings pending regulatory finalization. Japan remains one of the most structured and institutionally aligned crypto markets globally, with a long history of regulatory clarity compared to other regions. Meanwhile, in South Korea, Hana Bank has reportedly taken a significant position connected to Danamu, the operator of Upbit, one of the country's largest exchanges. The firms are also reportedly working toward infrastructure supporting a won-denominated stablecoin ecosystem. This is important because it reflects a consistent trend. Banks are not resisting digital assets anymore. They're preparing infrastructure to operate alongside them. And finally, we need to talk about XRP, because this is no longer sitting in the background of market speculation cycles. It's now consistently appearing inside the same institutional conversations we're seeing across ETF structures, tokenized asset frameworks, and regulated crypto product design. Reports around diversified crypto ETF structures continue to include exposure to assets like XRP as part of a broader basket-based digital asset strategies. And what's important here is the shift in context. A few years ago, XRP was largely discussed in isolation, tied almost entirely to legal overhang and exchange uncertainty. Now it's being positioned differently, as part of a multi-asset crypto products designed for institutional and advisory allocation frameworks. At the same time, XRP continues to be referenced in discussions around cross-border settlement infrastructure and liquidity routing systems, especially in conversations focused on efficiency, speed, and regulatory alignment for financial institutions. So the narrative has clearly shifted from will this asset survive regulatory pressure to how does this asset fit into emerging tokenized financial systems? And that shift matters, because once an asset transitions from retail-driven narrative cycles into structured financial products and infrastructure conversations, the market behavior around it changes completely. It stops being purely sentiment-driven, and it starts being system-driven. So when you zoom out, the picture becomes a lot clearer. Yes, the market just went through a sharp liquidation event, but simultaneously, regulatory frameworks are advancing, tokenized financial products are being launched, global banks are integrating blockchain systems, and governments are actively experimenting with on-chain infrastructure. That's why the market feels split in two realities right now. In the short term, fast volatility and leverage-driven moves. In the long term, system-level financial restructuring. And somewhere between those two layers, the future financial system is gradually being built in real time. But I want to know your thoughts. Are we watching the early stages of a new financial system forming? Or is this just another cycle of hype and overextension? Drop your thoughts below. If you enjoyed this episode, like, subscribe, and turn on notifications. And I'll see you in the next one.